It is true that leading into the final stages of the election, it can get a little bit more jumpy in equity markets, and part of that relates to the fact that markets just like uncertainty.
Well, welcome Carolyn Kwan to the Steadyhand Coffee Break video series.
Thank you very much for having me, David. Pleasure to be here with you.
Carolyn is a portfolio manager and product specialist in fixed income with the Connor Clark & Lunn investment management firm and a key member of the investment team that manages the Steadyhand Income Fund. Now, this is a diversified and balanced portfolio of Canadian bonds, dividend-paying stocks, and real estate investment trusts. And the fund is an incredibly important part of most of our clients' retirement income needs. Now, Carolyn, you're an expert in a whole bunch of different investment areas, the economy, interest rates, inflation, and I hope to discuss these things with you in upcoming videos. But given that we're in the final stages of a run to the U.S. presidential election, let's focus on that. And with just a few weeks to go before November 5th, let's start with some historical perspective. First off, have past U.S. presidential elections impacted stock markets returns historically? And frankly, are there any consistent patterns that you can discern from this?
Well, stock markets are often thought of as being a bit more volatile during an election year. But if we take a look at some of the averages over the last 30 years, so if we look at the average of non-election years and compare that to the average volatility of election years, the index that measures that kind of volatility actually doesn't show a very big change or difference between those two groups of time periods. It is true that leading into the final stages of the election, it can get a little bit more jumpy in equity markets, and part of that relates to the fact that markets just like uncertainty. But you did ask about patterns, and I think if we were to take a look all the way back to the Great Depression, so 100 years of elections and stock market performance, so we have 25 elections during that period of time, there actually don't appear to be consistent patterns. The chart that you see here shows the stock market performance over those 100 years. And so if you invested a dollar, what would that look like over this period of time? And you can see that generally stocks move up, and there are periods where you do see stocks sell off, but there's no real consistency or pattern with respect to elections.
On that theme of patterns, is there any pattern to the party? Like, is there any sort of influence on markets that different parties have? And I would imagine that over the course of time, with parties becoming much more divergent, maybe that pattern is more apparent.
Well, common wisdom does suggest that Republicans are generally pro-business, and that should be good for equity markets. But actual performance actually doesn't back that up. If you were to look at, for example, the same 100 years, and break that down between the presidential parties, you can see actually that there are up periods and down periods from both. But that if you average out the Democratic years, the years where the president was a Democrat, they actually outperformed the years that we had a Republican in the presidency. Now that does sometimes have to do with circumstances more than the administration per se. For instance, you have periods of time where the stock markets actually had a very large drawdown. One example is the tech bubble in 2000 or the great financial crisis in 2008. Both of those occurred during Republican presidencies. Another example actually occurs when you have low inflation periods. So since 1990, we've been in a period of low inflation, and equity markets tend to do well in those periods of time. And since 1990, if we were to look at the terms where we had Republicans versus Democrats, we happen to have more periods where we had Democratic presidencies. So part of it does relate to the president who's in power, or the party that is in power, and oftentimes it does relate to circumstance. And I'll also mention that it's worth keeping in mind that the analysis that we do over history, over the different types of policies that parties have, can be oftentimes upended. 2016 was a very good example of this. Every time Hillary Clinton went up ahead in the polls, the stock market went up, and vice versa. And then on the night of the election, when it was clear that President Trump was the winner, we had the equity market futures selling off. But in the days, weeks, and months after that 2016 election, we actually had the stock markets do very, very well. So indeed, a lot of the analysis that goes into it can actually come out to be different than what people had originally thought it would be.
Not only is it uncertain, it's often counterintuitive as well. So Wow. Okay. Well, speaking of uncertainty around election periods, how does this sort of election cycle uncertainty affect investor sentiment and related to that market volatility?
Yes, well, as I mentioned, markets typically do like calm or predictable business environments in aggregate. Businesses really want to have that ability to make long-term decisions on things like hiring and whether to build a new plant or whether to buy some more equipment. And anytime you introduce uncertainty, it does cause hesitation among businesses. Are we going to have more or less regulations? What are the tariffs going to look like? What are taxes? What are corporate taxes going to be? These are all things that do delay business decision making and create uncertainty for markets. In addition to that, you can have periods of time or periods of elections where the outcome is a little contentious. When you have uncertainty over whether an outcome will be determined clearly and quickly, these also weigh on investor sentiment. And as we all know, the polls are currently pretty split at the moment. And I guess one more observation to make is that there really has been, periods of time where you have presidents, that are incumbents and they win again. There are periods of time when you have a new president come in, and historical relationships or historical experience does suggest that markets are perform better when you have an incumbent president that wins re-election versus having a new president come in. And again, this is all tied to the uncertainty aspect. But it is worth noting that businesses ultimately do adapt. There are new environments all the time, and businesses adapt, and equity markets continue to do well.
Now, it's a big world out there. It's not just about the U.S., but do U.S. presidential elections have an influence, like an outsized influence on global markets? And then looking globally back into the U.S., do international investors have an impact on U.S. stocks during this period of time?
Yeah, the U.S. certainly is, the world's largest economy and is very influential globally. So every election does have some impact in the world, including global equities. It is, I think, perhaps overstating that other countries' equity markets will move, lockstep with one party or have a preference for one president over another. Fundamentally, every country's stock market does move alongside that index's corporate profitability, that country's economic cycle, that country's own international relationships and their own currencies, their own trade policy. So each of these will have a more influence over their own equity markets than, say, U.S. election might.
Now let's take that from the big macro perspective and bring it right down to individual investors. During this sort of heightened period of uncertainty and potential volatility, what's your advice for individual investors during an election year? I mean, should we be making any big changes to our portfolio, becoming more defensive, more aggressive? What should we do?
You're absolutely right. This is a very big election year, and not just from the perspective of the U.S. This is a year where we've actually seen a number of elections. In fact, an unusually large number of elections in different countries. We've had the UK, France, India, the US, and in fact, about half of the world's population is going either has gone through or will go through an election in 2024. So it is a lot to keep track of. For the U.S. specifically, it's oftentimes the case where we'll be focused in on the presidential election, but we also forget that the U.S. Congress and the U.S. Senate will also be determined in November. And it's notable that policy often does shift somewhat depending on whether one party controls all three levels or whether there's a split. And so having a split government does introduce a little bit more compromise into these bills that are passed. And so, when you have these situations where you have uncertain outcomes or maybe a contentious election or a lot of very thought-provoking headlines, it's important maybe not to let expectations or emotions or forecasts around politics specifically to lead to short-term decision making. And so you asked, what should investors do? What should we think about doing? It's notable, I think, throughout our whole conversation today that there aren't really clear strategies through these past 100 years. And oftentimes the common wisdom on things like political parties or policies actually often turn out to be different. They don't pan out the way you expect. And so as with investing in general, it is important to keep focus on your longer term plan. Make decisions with perspective on your goals and stick with them with that calm and that thoughtfulness that you really do need to separate from all the noise that you get from the headlines.
Well, I think that's wise advice. And frankly, it's why we named our company Steadyhand. It's the most important feature of successful long-term investing. Now, Carolyn, if anybody's interested in digging deeper into the research that you and your colleagues at Connor Clark and Lunn are producing, how can they find that?
Well, we actually do have a place on our website, and I'll send it over to you, and we can share that with all of your viewers.
Okay, well, we'll be sure to link to that site in the video notes below. And Carolyn, thank you again for those wise words and taking us through this complex time for investors and, frankly, the population writ large. And thank you all for watching. If you have any comments or questions on what you've heard today, please do drop them in the comments section. We'll do our best to address them. And be sure to also subscribe to the Steadyhand channel if you haven't already to be notified when we upload new videos. And with that, again, Carolyn, thank you. And thank you all for watching. Bye for now.